Welcome back guys to another Zero DTE video, and today Ernie's going to be talking about optimizing trade entries, so make sure you stay tuned. If you're interested in becoming a pro trader, check out the link in the description where you can find Ernie's education platform. Enjoy guys.
The profit management framework is very comprehensive. It takes into consideration the time of day that you're in, the position of the trade, the underlying market structure, the volatility, all kinds of things. And it's very compartmentalized and allows you to treat each day with its own specific logic. So that's all great. And when you become skilled at that, you can really create fantastic returns. Now, the one biggest question I think most people have, and the thing that baffles new members, is how do you get into the trade? What is the process by which you get in? They are so steeped in this cultural or industry-wide belief that the entry is the most important thing. And, you know, it is important if you have an idea of what you're going to do once you enter it or why you're entering a trade. In our trade, the general entry is somewhat important. We get in the morning basically because we're looking for at least some volatility crush to aid in our strategy, but that's not the real basis behind the trade. The real basis behind the trade is putting on a capital efficient trade, one that has extreme risk to reward, and one that is properly priced, that has the right width and cost so that it's in line with your personal capacity and tolerance for risk. Those are the important parts. Getting in, the exact timing, what's the underlying market structure, for the most part, it doesn't matter. We can get into the trade sometime in the morning, somewhere between the open and 10:30, 11 o'clock, around there. Doesn't matter. As long as we put on a good risk to reward, a 1 to 9 or better, we're good to go. And in terms of the width, sometimes when we have a volatile market, we might go a little wider. When we have a less volatile market, like right now, we might go a little narrower. But other than that, there's not a big difference. You find a time that you can get in, and then you get in, and then you manage the trade. There are two ways to take this trade. Now, it is a directional trade, or it can be a market agnostic trade. That's the basic difference between the out-of-the-money butterfly, which is a directional trade. You can either have an out-of-the-money call butterfly, and all of our butterflies that we put on, by the way, are long butterflies. We don't use the iron butterfly. There's really no need to add complexity to the trade. Now, one question I get a lot of is, well, geez, if you're not an iron butterfly, if it's not collecting premium, then how can you collect premium? Well, there's a big misnomer that just because you have an iron butterfly as opposed to a long butterfly, and one's a debit, one's a credit, doesn't mean that both of them don't collect premium. They do. They both have short strikes on them that actually are doing the premium collection. So this idea that it has to be a credit in order to collect premium is really just a fallacy. So we put on a long butterfly because it's easier, it's simpler, easier to manage, and we put it out of the money so that we can create a proper risk to reward. If we believe that the market's going up or we have a long bias, then we put a call fly above the market. If we believe the market and we have a bearish bias, then we put on a put fly and put it below the market. If we don't really have any idea, which is most of the time, or at least half of the time, then we put one both above the market and below the market. Now this one turns out to be, something that looks like Batman's ears, therefore we call it the Batman trade. Now the big question is, which one? Out of the money call, out of the money put, or the Batman? That is the question. Well, here's an undeniable truth. It mostly doesn't matter. And you might think, man, that sounds really weird. Why wouldn't it ever matter? The reason why it doesn't matter is that the Batman and the out-of-the-money butterfly, if you're going to trade the Batman all the time versus just picking a direction with the out-of-the-money butterfly, either above or below the market, based on whatever you think is going to be right for that day, for the most part, you're going to be about a 50-50 trader either way. In fact, you might be a little bit higher in terms of your win rate with the single out-of-the-money butterfly because you might have a particularly good knack for choosing direction. But still, you're not going to be that right because even when you think you have the right direction, the market might end up going the other way. So it's going to end up probably, and this has been my experience, and I feel like I'm a pretty good judge of choosing direction. I've been anywhere from 55 to 60, maybe 65% correct if I choose direction and choose an out-of-the-money fly. Now, if you choose a Batman, it doesn't matter, right? The only way you can be wrong with a Batman is if the market neither goes up or down and just stays right in the middle, and then you're wrong on both sides. So the Batman tends to have a slightly lower than 50-50 win rate, probably closer to 45%, 46%. In fact, my current win rate is about 46%. Now I do a combination of both Batman and out of the money butterflies. So let's take a look at what are the up-down statistics of any market. Now, I'm going by memory, but I've looked at this many times, and it's pretty much the same no matter what market you look at. But take any yearly market, a year or a quarter or a month or any span of time, and regardless of whether it's a bullish market or a bearish market or a sideways market, look at the number of days that are up days versus the number of days that are down days. Even in a bull market, your up days and down days are going to be approximately 50-50. You might have a slight edge on the high side, maybe 52-48. And for all the down days, it's the same deal, 50-50, maybe 52-48 on the down days. But that's not a given. I mean, you could literally have more down days than up days on a bear market. The difference that would make it a bear market is that the down days tend to outstrip in terms of magnitude of the move compared to the up days, and vice versa for the bullish market. On a sideways market, it's anybody's game. Again, 50-50. In general, if you take all of the trades over the course of a year, you'll find that it is approximately 50 going up, 50 going down, right? Now, that doesn't say anything about the magnitude of the move. That magnitude of the move will vary. On average, it might be somewhere between 0.8 and 1.2% of the total market value. So that's kind of, and then every once in a while you get a 1.5% move or a 2% or even a 3%. Those larger moves are more like outliers. So the vast majority of your moves are going to be between 0.5 and 1.25%, something like that. And whether they go up or down, it's anybody's game. So think about that. If you're going to put on any kind of trade, whether it's a bullish or a bearish trade, and in this particular case, we're looking for both a move as well as premium collection. So it's a combination of the two. They work off of each other.
Thanks for watching, guys. I hope you enjoyed the video, and if you did, make sure you hit that subscribe button and hit the like button below. If there's any questions that you might have for Coach Ernie, make sure you leave them in the comment section. Thanks, guys.